Welcome to AI Explains ICT. In this overview, we're going to be covering the core content Month 1, Episode 8. We'll be talking all about impulse swings and market protraction. So, let's just dive right in.
So, here's what we're going to cover in this video. We'll start with the basics, decoding those impulse price swings. Then, we'll get into something called market protraction. After that, we'll look at the key time-based triggers. This is super important. We'll combine those two ideas, and finally, we'll walk through a practical trade example to see how it all fits together.
All right, first things first. Before you can do anything else, you have to learn to see the market's basic rhythm, its language. And that language is spoken in what we call impulse price swings.
So, what is an impulse price swing, really?
Well, you can think of it as price moving with real intention. It's a clear, decisive move from a major high point to a major low point. Or, from a low back up to a high. Getting good at spotting these it's really the foundation for everything else we're going to talk about.
And this is where it starts to click. See, when you start tracing these swings on your chart, from high to low and from low back to high, you stop seeing just random ticks and noise. You're actually mapping the market's story, its natural flow. This is always step one to figuring out what price is up to.
Okay, so we've got the basic rhythm down. Now let's add a really critical layer to this. You see, not all impulse swings are the same. Some of them are designed purely to trick you. This is what ICT calls market protraction.
The big difference here really comes down to two things: timing and intent. A normal impulse swing is just a general price movement, but a market protraction, that's special. It's a swing that happens at a very specific time of day, and its only purpose is manipulation. It's like the difference between a normal ocean wave and a sneaky rip current designed to pull you in.
And this quote from ICT just says it all, doesn't it? Let's be super clear. These moves are not organic. They are specifically engineered to fool people. They want to make you believe the market is making a nice, solid low that you should buy right before they pull the rug out from under you. It's all about trapping people on the wrong side.
So, if these moves are engineered, that means they can't be random, right? Exactly. They happen at very specific times, almost like clockwork. So let's get into the time-based triggers you absolutely have to watch for.
In any 24-hour cycle, there are pretty much three main windows where you need to be on high alert. First, there's a small one in the Asian session, right around 0 GMT. Second, you've got the big one, the famous Judas swing, which is a fake-out move that kicks off after midnight New York time. And third, there's another key move that sets up in the New York session after 7 a.m.
Okay, I'm going to pause here for a second because this is so important. For that New York session move we just mentioned, the rule is strict. It's not a suggestion. This counter move must happen after 7 a.m. New York time. Not at 6:58, not a minute before. It has to be after 7 o'clock. You got to burn that into your brain because that time is the trigger. All right, so we have these two really powerful ideas, right? The big picture direction from the impulse swings and these precisely timed manipulative moves called market protraction. Now, let's put it all together and see how it forms a complete trading model.
The strategy actually becomes pretty simple and honestly quite elegant. Step one is just to figure out the market's real direction using that larger impulse swing. Are we fundamentally moving up or down? Then, step two, you don't chase it. You wait. You patiently wait for that time-based market protraction, that fake-out move in the opposite direction, and that becomes your signal to get in.
Theory is great and all, but I know you want to see what this actually looks like. So let's break down a real chart from ICT and watch this model play out in the real world. Okay, so check this out. First, we spot a huge impulse swing to the downside. That right there tells us our overall bias is bearish. We should be looking for sells. But price doesn't just fall off a cliff. It rallies back up. It retraces right into what ICT calls a premium market, a perfect area to look for a sell, right around that 62% fib level.
And here's the magic. That rally up into our sell zone, that's not strength. That is the market protraction. That's the manipulative move we've been talking about this whole time. It's designed to look bullish, to suck buyers in, right at the exact moment the smart money is looking to sell.
But why? Why would the market do this? Well, the goal is to build up field to go in the true direction. The market is being drawn like a magnet to its real target, that giant pool of liquidity, all those sell stops sitting just below the old lows. The protraction, that fake rally, creates the power needed to go down and attack that liquidity. It's deceptive, but it's incredibly efficient.
So the big takeaway here is that when you start combining the big picture impulse move with the specific timing of market protraction, you can actually start to see these setups forming in real time. The question is, now that you know what to look for, can you spot the next one before it happens?
I really hope this video helped connect some dots for you. Look, we pour a ton of effort into making these explainers as clear as possible. So please, I'm basically begging you here, like this video and subscribe to the channel. It honestly helps us out so much. And if you have any questions about any of this, drop them in the comments below. A human representative will actually get back to you. Safe trading out there.